Hello, everyone. This is Justin Barden with First Horizon Advisors. I'm here with you today to talk about investments. This is the third version of the courses for the Fiscal Wellness Program that's offered through the Professional Development Center and the CPP program, the CPP Certificate Program. I hope you've enjoyed the first two courses, which focused on budgeting and on personal credit instruments. Both of those sessions were highly engaging, and I appreciate all your questions. And at the end, I know there may be questions about investments after today's session. If you do have any questions, please feel free to reach out to me via email. You can find me in the system in the University of Memphis. It's jcbarden@memphis.edu. JC, like Justin Charles Barden, at jcbarden@memphis.edu. Please feel free to email me with any questions that you have. Okay, here's our disclosure. And today's presentation will focus on three things about investments 101, the basics, choices, and opening an account. In the basics, we'll talk about just basic information. Some of it may be familiar to you through some of the other courses that you've done. Choices for different types of investments that you can invest in, and then finally how to open an account. I would encourage everyone after the presentation today to strongly consider opening an account so that you can start making progress towards your long-term goals and objectives. Okay, so we'll start out with some trivia. And the first question is, who was the first person to climb Mount Everest? Excuse me, everybody knows what Mount Everest is. It's the largest mountain in the world. You got a picture of it there. The first person to climb Mount Everest, though you may not know, is George Mallory, and he actually accomplished that feat in 1924. He made it to the top of the mountain. But most people recognize Sir Edmund Hillary, who's from New Zealand. You see his picture on the New Zealand $5 bill as the first person to reach the top and is credited with being the first person to climb Mount Everest. That's because Sir Edmund Hillary actually made it to the top. He summited and he made it all the way down off the mountain. So George Mallory summited the mountain but never successfully made it to the bottom. Sir Edmund Hillary was the first person to actually go up and successfully down the mountain. So how did Sir Edmund Hillary succeed when George Mallory failed? Well, Sir Edmund Hillary actually brought along a professional guide. His name was Tenzing Norgay, and in 1953, they made it all the way to the top. Tenzing was from the local area, from Nepal, and his body and his bloodstream was acclimated to the high altitude and the low oxygen levels that are found up there on the mountain at high altitude. And so the professional guide that Sir Edmund Hillary brought with him to assist in this journey actually resulted in his successful ascent and his accomplishment of his goal. So the story here as it relates to investments, as you start to climb your personal Mount Everest, which is a long-term investment goal that's going to support you, a goal that you're going to be on between now and the next 40, 50 years, don't hesitate to reach out and see the wisdom in using a professional advisor, someone that is acclimated to the environment that can give you great advice and support you along the way. I want to start now with the basics, which are a little bit of a discussion about the traditional investments, and then we'll talk about non-traditional investments as well. Here are the traditional investments. These are things like stocks and bonds and cash. On the screen, you see a picture of one share of Netflix. Everybody is familiar with what Netflix is. You probably have a subscription, but you can be an owner of Netflix by buying stock in the company, and this is equity. Equity means you own a portion of the company or a share of the company. Fixed income, you see a bond from the state of North Carolina represented on the page there. That means that you've loaned the state of North Carolina $1,000, and at the end of the bond, at the end of that loan agreement, the state of North Carolina owes you your $1,000 back and interest along the way. So with a bond or fixed income investments, you're actually loaning money to a particular investment in a stock, you're purchasing, you're an owner. So it's the difference between being an owner or a loaner. And then finally, cash is also considered a traditional investment. These are things like money that you'll keep in your pocket, obviously, but also in your savings account or a CD at the bank. Non-traditional investments or alternative investments, you can think about these as what we call ants. These are things like real estate, commodities, and currencies. People can invest in these different asset classes. They are different and non-traditional, meaning with commodities, you can invest in futures contracts, and you can invest directly in gold or precious metals. You can invest in farm products. You see corn on the page there as well. There's a number of ways that you can invest in these commodities. These are highly volatile, highly speculative investments. You also have real estate, which is one of the widest held investment categories out there. For most Americans, their home or their personal real estate is their largest piece of their net worth. So also considered in your long-term financial plan is the amount of capital that you'll have invested in real estate through your primary home. Over time, this is a long-term view of the stock market and the markets overall. We also have bonds and treasury bills and inflation represented in the chart. But what this shows you is a $1 invested back in 1926 into 5 different investments. The dollar invested in the small cap index or small companies. These are companies with market caps of less than $2 billion is the way that you would think about these today. Small companies over time have produced the best overall long-term return. So you see $1 invested in 1926 in the small cap index is worth over $22,000 today. In the large cap index, these are like companies in the United States with a market cap of greater than $10 billion. A dollar invested in large companies over in the large company index from 1926 to present is worth over $7,000. And one thing to note there is look at the dramatic difference between small cap and large cap, but look at the difference between stocks and all other investments. The spread there between stocks and bonds is just so dramatic. So for investors that truly have a long-term time horizon, that are going to be an investor for 30, 40 years, for their retirement funds for sure, owning stocks has been the best way for investors to truly have a growth, to have growth in their investment dollars and to have a long-term total return. With the stock market, this is also going back to 1926. But it shows the different periods of what you call bull or good and bear or bad markets, bull and bear markets. And so you see the duration of the bull and bear markets on the page. The blue or the positive returns on the page outnumber the red or the bear market returns significantly. There's a lot more blue on the screen than there is red. But you do see some of those red periods can be very swift and severe. If we updated this chart to current time, we would also have another red slice. We've, in the last month, just entered another bear market period. In the last month alone, the stock market has fallen by 35%, and which has been a very, very swift and severe downside move. However, if you look at all other periods of time, those red periods of time or those bear markets have been followed by a significant bull market run. So the good news here for you as an investor, perhaps that's a new investor, you are getting an opportunity to enter into this investment world at a time that is great. So obviously you want to buy investments when they are on sale or cheap, and you want to sell them when they are expensive or highly valued. So now is luck and timing for you. It's a very difficult and challenging time that we're going through in the markets for investors that have been investing for a while. However, for you as a new investor, this is a great time to get started. Let's take a look at some examples of how returns work. And I've got a gross return or a total return there on top of 8%. But you have to factor in taxes and inflation. So I have a 25% tax rate So that equates to 2% of your return. That leaves you a net return of 6. And then you have to think about inflation as well. In the United States, inflation over the last 10 years or so has been roughly 2%. So if you take the inflation out as well, that 8% return has now turned into a 4% real return. So the real return is what you really want to be focused on, because you have to factor in taxes and inflation into your personal lives going forward. As you make money and earn an income, you will pay income taxes. As you spend money at the store, you pay sales taxes. Taxes are a part of our life, whether we like it or not. And then inflation is also something that we have to deal with. A lot of people call it the silent killer. It's something that you just deal with that you don't necessarily think about. But inflation needs to be factored into your long-term plan for sure. Let's take a look at inflation over time. 41 years ago, in 1979, a new home cost $50,000. And all the way in 20 years later, most of you are probably about 20 years old right now. This is when you were born. A new home cost $195,000. And then present day, this is back in 2018. The new home price at that time was $388,000. So you can see how the price of goods and services in all these different categories goes up and to the right over time. So the question at the bottom is, where do you think prices will be in 20 years from now, in 2040 and in 2060? In 2060, this is going to be when many of you are going to be thinking about retirement and leaning on what you've saved over the course of your career to meet, to continue to pay the bills and provide an income to you. So the question here is where do you think prices will be? They will most likely be higher. So if you believe that history repeats itself in this category, then you need to be an investor and you need to produce a return that will outpace both taxes and inflation. A couple of other basics that you need to understand about being an investor is, number one, you need to align your investment goals with your strategy for your account. So some goals that most investors have are, they may be to create more cash flow or income. Another goal that a lot of investors have is to retire at some point in the future. Another goal may be to send their kids to get their kids to college. Another goal may be to retire comfortably. Another goal may be to leave money to others or leave money to charity. So no matter what your goal is, it's important to really understand what your primary goals are and then align your investments to line up with those goals and objectives. The second thing you want to do is understand how risk factors into your strategy. A lot of investors do not like to take any risk. They would say that I'm more conservative and I do not want to invest in such a way that I could lose my principal or have a loss of any value. Now, there's a trade-off. The higher risk you take, or by taking some risk in your portfolio, it allows you to have a potentially higher return. So if you take no risk, you're essentially saying that I don't care about the return. I'm more confident in the security of my principal. However, some other investors may say I am comfortable with taking some risk because I need to have those higher returns. In order for my financial plan to work, I'm going to have returns that beat the conservative investments. And so I'm going to be forced to take some risk and in order to get those better returns. So what a lot of clients lean on in the end is a diversified mix of investments where they have some conservative investments and they have some aggressive investments, and they have a balance between risk and safety. And that is in a lot of ways the best way to provide a long-term return that matches up with a smooth risk tolerance. Okay, and then lastly, investments must align with an investor's time horizon. So these are just general rules of thumb here. A short-term time horizon is less than 3 years. Intermediate term is 3 to 10, and long-term is greater than 10 years. For all of you that are wanting to retire at some point in the future, that's going to be certainly a long-term goal. And so you need to invest appropriately for your long-term goals and objectives. If it were an intermediate or short-term goal, then you wouldn't want to take as much risk. All right, so we're going to get into the choices now. Choices are out there. There are thousands of different choices that you can make in your investment strategy. But let's just break it down into two basic categories. These are individual securities, so you can buy stocks of companies or equity investments. You can buy bonds or fixed income or options. You can buy these in what are called packaged products. These are things like mutual funds or exchange-traded funds. And then you see the list of the different categories: active, factor-based, passive, income-focused, impact, or socially responsible. These are 5 common categories. I'll give you a bit of a definition of the 5. So active investments, these are mutual funds, also called investment companies, that appoint a portfolio manager to invest assets in an effort to outperform a stated benchmark. So mutual fund companies will have a portfolio manager that has a goal to invest in large company stocks, and their goal is to beat the performance of the large cap index. And if they are successful, then they can produce returns that are 2 or 3 or 4% better than the index. They charge a premium price for this, so you pay for the skill and execution of the manager, and if they are beating the index, then there is value added to the client's investment. Okay, so that's active investments. Factor-based is next. This is a growing category that has some feel of active, but is also it's also passive in nature. But these investments, either in mutual funds or ETFs, they are investing along what are called themes or factors. So some example themes are quality. You can buy an ETF or a mutual fund that only invests in quality companies. It's like one of the example for a quality company is one that is profitable. It may perhaps pay a dividend, but it shows the ability to create a sustainable profit over time. Another example would be value investments. These are investments that have very low valuations or PE ratios. Momentum or market cap. So a market cap example would be something like small cap. Passive investments, these are index investments. They're very low cost. There's no frills to them. They're very low cost. It's a mutual fund, and the index is replicated through the fund. So let's say that it's an S&P. If you're familiar with the S&P 500, the S&P 500 is the 500 largest companies in the United States. It's an index. If you buy an S&P 500 fund, then you're buying shares of a mutual fund that simply replicates those 500 companies. And you can do this at a very, very low cost. All right, the last two are income focused. So for many clients, they want to invest in portfolios that can produce a income either through bond investments or stock investments, dividends from common stocks or preferred stocks, or income payments from bonds. The different types of bonds are corporate, treasury, and municipal bonds. And then lastly, the impact or socially responsible. This is a growing category that allows investors to have more of a social impact on their investment strategy. So number one, it allows investors, if they would like, to remove certain things from their portfolio. Let's say that if you did not want to invest any of your dollars into companies that manufactured firearms, for example, this category allows you to restrict any investments in firearms in your portfolio. You also have the ability to positively impact certain things that may be a part of your personal value system. So, for example, if you strongly believed in companies that made an effort to promote gender equality, then there are ways that you can invest in companies that score very highly on gender equality or that are leading in many of these different sustainable development goals. I have a picture at the bottom of the page. This is a picture from the UN Sustainable Development Goals website. And I would encourage everybody on this webinar to go out and check out the UN Sustainable Development Goals. There are 17 goals that are out there to make the world a better place. And this category of investments, impact and socially responsible, is doing its part to help promote those sustainable development goals. All right, so lastly, I'm going to cover here how to open an account and get started. There's two basic ways you can do this, either on your own or through the help of an advisor. Let's start with the self-directed choices first. The benefits here are you can do it for a very low cost. There's very low minimums to open an account relationship. There is impressive technology, and I have support question mark there. In many of these options, there are support options available, but it's likely not a personal relationship. It's not going to be someone that is going to get to know you and work with you individually. It's more of a call center or online chat box type of experience. That may be what you're looking for, but for some, they want to have a more personal experience and get to know someone. So some examples of companies that offer self-directed accounts are Fidelity, E-Trade, Scottrade, Betterment, and Charles Schwab. Professional advisors focus more on financial planning, building personal relationships and investment strategies with clients, helping clients overcome some of the emotional or behavioral issues as it relates to investing. And they also typically have a bit higher cost to work with a professional advisor. That makes sense, right? If you're getting a stronger relationship and getting to work with someone individually, you would anticipate that it would cost a little bit more. Our firm, First Horizon, is an example of one of the options that you have for professional advisors. There are other options that are available out there as well. But the question here is, should I do it myself? And I just always rely on this chart to show the performance of the average investor over time and how they've performed doing it on their own. So do-it-yourself projects are great, but not always great on the investment side. So if you see, this is returns from 1995 to 2015, and the stock market over that period of time returned over 8%. The average investor is all the way at the far right there, 2.11%. So the average investor significantly underperformed the market over that period of time. And why is that the case? Well, it's all about this chart here. Many investors follow their emotions, and they start to get comfortable and want to buy investments when they reach optimism or the elation stage. That's when investors get comfortable and they say, well, things are going really well and I'm comfortable with investing. But then when we go through periods of volatility like we're in right now, the market has fallen 35% in the last month alone, which has caused a lot of people to be nervous and fearful, which is completely natural. However, it's the opposite of what you should want from an investment standpoint. There's a lot of investors that are thinking about selling out of their investments today because they're very fearful and nervous when they should be reallocating back to stocks and adding more money to stocks because they can do so at a much lower price. So think about price along the line here, and when is the best place to buy it? The best place to buy it is in that fear range when the price is at its lowest point. One of the best investors over in the history of the United States is a gentleman named Warren Buffett. He's still alive today. And Warren Buffett's famous quote is, "Be fearful when others are greedy and greedy when others are fearful." And his quote is essentially what's represented in this picture here. You want to make investments when others are very fearful about doing so. And actually last week, his company, Berkshire Hathaway, actually made a significant purchase into Delta Airlines, which the airline industry has gotten absolutely clobbered in this most recent downturn in the market. But his company stepped up and they made a significant investment in Delta in the last 2 weeks. Okay, back to getting started and opening an account. Step one, like we talked about in the first class, it's important to develop your budget. Go back and review what your budget is. How much money do you have every month that you can invest and save? Understanding that number is critically important. The second thing is to prioritize your goals. So understand what your goals and objectives are and make sure that your dollars are aligned with those goals. And number three, open an account and get started. Start contributing. So the picture here is as money comes in, you have the ability to put it in different places. I have the most three common investment goals listed on the page. Those are emergency savings, retirement savings, and investment savings. It's actually possible to accomplish all three of these at once. You can set up your emergency savings account with the bank and begin to contribute to that monthly. You can also contribute to an investment savings account. Typically, this is taxable, where you can buy things like stocks and bonds. You understand that there's going to be a different time horizon for this and that the investments are taxable. But you want to start making contributions to an account like that so that you can have the flexibility and those better potential returns in that account. And then lastly, your retirement savings. This is a tax advantaged account where you can invest for your future retirement that is going to be 30, 40, 50 years from now, when you'll lean on what you've saved and you'll draw an income from that to maintain your standard of living at that point in time. This has been a great exercise to get to know you all, and we've actually accomplished doing some financial planning for you personally through this fiscal wellness class. And I hope that this has opened your eyes to what's possible in the wealth management industry. There's a great opportunity for you here at the University of Memphis, and that is to participate in the InvestNet Institute on Campus program. The InvestNet Institute on Campus program is offered to 25 students a semester. It's completely free. You get to learn all of the latest and greatest information about the wealth management industry, the technology and the jobs that are available that are supporting the wealth management industry. So if you'd like more information, please contact Vivek Sharma in the finance department or Kathy Tuberville. They have access to information to get you signed up. And go out to their website, investnetinstituteoncampus.com, for more information. After completing the InvestNet program, you'll have the opportunity to upload your resume to the DAC Resume Hub and put yourself out there for consideration amongst so many companies across the United States. There are large asset management firms and firms just like First Horizon that are hiring from this DAC Resume Hub. So do yourself a favor and participate in that program. And then if you're highly interested in becoming a financial professional, there are 2 certificate programs offered through the School of Business, the School of Finance, both the CFP certificate program and the CFA certificate program. These certificates are the gold standards in the industry for financial planning and for money management. So if you are more in line with understanding financial planning like we've done in this class and would like to do that as a career option perhaps, please ask about the CFP certificate program. And then finally, if you are interested in the dynamics of money management and are an analyst, then the CFA is a terrific accomplishment, and you can complete these certificate programs here within your coursework before graduation and have a leg up for passing these exams as a professional. Lastly, I just wanted to quickly note that First Horizon Bank and First Horizon Advisors, we are the official financial partner of the Tigers. We appreciate the relationship with you all, and go Tigers go. We appreciate all that you're doing. Congratulations on all your hard work in the CPP program. And if you have any questions about your personal financial situation and you need some help, feel free to email me. Again, it's Justin Barden, jcbarden@memphis.edu. Thanks, and I'll see you around campus.